Hey there, everyone. Welcome to the Final Bar. It's Thursday, May 23rd. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. And boy, days like today remind you why charts are a really valuable part of your toolkit, as we've seen NVIDIA gap higher after crushing earnings yesterday after the close, but not enough to bring the broader markets higher along with it. The Dow down over 1.5%, the S&P down as well, back below 5,300. A lot of downward movements and a lot of things that you felt certainly seemed like an unrelenting uptrend. The changes may be happening here. We have a great guest today, Jeff Hughes of JWH Investment Partners. Some thought-provoking charts I think he'll share with us to really try to put a day like today into proper perspective. Think about the larger themes at work here as we look at some weekly, even some monthly charts. With that in mind, let's get to our market recap and look at how the charts evolved. A lot of red on the monitors today. Before we get there, I do want to ask you a poll question we had recently. Which growth sector performs the best over the next months? You've got 4 weeks and one sector to pick. 69% of you saying XLK. I would wholeheartedly agree with that assessment. I don't know how you could pick the XLY, to be honest with you, given the technical configuration. The XLY has been underperforming. The XLY is dominated by stocks like Tesla that continue to underperform. Home Depot is now broken below its 200-day moving average. So 2 of the 3 biggest names in the XLY are hurting for certain. And as a result, the XLY has been underperforming most other sectors here recently. XLC kind of in the middle. And one of my favorite charts, by the way, to think about that potential rotation is on my Mindful Investor live chart list. I have 3 sets of charts that I like to go through that are all looking at relative strength. So this is basically the relative strength of the technology sector. So just a ratio of the XLK to the SPY. Then we have communication services in the middle. We have the XLY consumer discretionary on the bottom. So start with that one. The purple line just consistently moving downwards. And this is from year end last year through today. I mean, every month has felt weaker and weaker than the prior month. And while it's had random signs of life like in February, overall, it has certainly been underperforming. So the XLY has been a rough place on a relative basis. And that's the game. That's what we're thinking about. When you ask which of those sectors do you think is the best, it's a relative strength question. So I would encourage you to answer that question using relative strength analysis. The XLC, as you see, has been basically a market performer off of the October low. The relative performance of communication services is basically sideways, meaning it's gone up and down along with the broader market conditions. That leaves us with technology, which into the end of last month had actually been underperforming most of 2024. But in May, the XLK has been outperforming the S&P. Very few, if any, other sectors have been outperforming in any meaningful way. It has been technology and then everything else. So when you see NVIDIA gapping higher, when you see stocks like MSTR and others, MicroStrategy within the technology sector popping higher, that's what's allowing this relative strength to improve, while most other sectors are seeing some dramatic underperformance right about now. Thanks for answering that question, that poll question, by the way. Don't forget to follow us on all your social media platforms so you won't miss the next poll question. Getting back to the market action today, again, as I alluded to, quite a bit of red. So if you like the color red, you will not be disappointed by the monitors today. The S&P down about 0.75%. So that's not an end of the world kind of day. Let's be clear, but it certainly is a big down day amongst a lot of up days that we've experienced so far in 2024. We're down just below 52.68, down about 39 points from Wednesday's close. The Dow leading the way lower, down over 1.5%. That's about 600 Dow points, closing around 39,065. The mid-cap and small-cap S&P indexes all down a lot more than the S&P. The NASDAQ composite only down 0.4%, and that's your best performer out of this group of major equity indexes. The VIX moving about a 0.5 point higher, so still relatively low. Let's be clear. We don't have any big alarm bells for volatility just yet. VIX below 15, in my opinion, is a non-story. That is a low volatility, sort of grinding higher type of environment, and one day doesn't change that. Additional days where you see a spike in volatility, that's where you need to start to be concerned. So VIX moving up a little bit, still within a very low volatility framework. Interest rates overall moving higher, and that was a big part of the story today. The reason we're wondering why the markets went down Economic data suggested a very highly functioning economy. Stronger economic conditions basically implies the Fed most likely waiting longer and longer for that first rate cut. Maybe less rate cuts need to happen less soon. As a result, rates are going higher, and as a result, risk assets are getting dinged pretty good today. The 10-year yield is up around 448. Your 5-year yield around 453. The long bond yield around 458. Bond prices, of course, moving lower if rates are going higher. So the TLT was down about 0.6%. The dollar index up slightly from yesterday's close. No real story there. Precious metals really feeling the pain today. Gold down over 2%. Same can be said for silver. Copper, crude oil down, but not slightly or slightly less than gold and silver. So gold overall has been one of the strongest parts of the market. As I get to my guest today, Jeff Huge, we'll talk about the gold trade. Maybe an interesting way to play that using gold stocks right about now. But overall, gold has still dominated year to date, even with today's pullback of around 2% for the GLD. Bitcoin, Ether, and other cryptocurrencies rolling over along with the equity trade today. Bitcoin is currently around 67,300. That's about 2.6% below yesterday's close. And I use the word close in air quotes because it does trade 24 hours. Ether price is down about 0.5%. You can see most of the other top 10 coins in the red today. All 11 of your S&P sectors closed lower today. Technology, the best performer of the bunch, but it was still down 0.8%. Materials and energy were after that, both down less than 1%. But again, your best performing sectors were still in the red. Only 3 of the Dow industry groups that we track actually finished in the green today, by the way. On the downside, some defensive sectors. REITs were down 2.2%, we'll call it. Utilities 1.7% lower. And consumer discretionary, the XLY, down 1.6%. Our market trend model, again, we don't change it during the week, but I'm certainly looking at that short-term level, looking at the stocks only. For now, they're still all bullish as of Friday's close. But more days like today, if Friday is a lot like Thursday, these could start to turn negative. Now, as a reminder, Monday, Memorial Day holiday, no show for us and no trading in the market, but we'll have to see with the shortened holiday week next week if we do get further distribution. And the way my market trend model works, the short-term model would theoretically trigger first. That's mathematically, that's the only way it can happen. So keep an eye there to see if we do get that distribution. You know, this chart of the mega cap leadership names tells you, I think, the story of today. NVIDIA closed up over 9%, 9.3% higher. It was up big in the after-hours session after reporting earnings yesterday, really suggesting that this whole AI thing is not done. They are still seeing explosive growth with great prospects for additional growth going forward. So the stock's certainly getting rewarded. It certainly seemed to me after reading that yesterday that today would be a big up day with the major averages pounding higher. We did not get that. What you have to remember is NVIDIA beating earnings tells you, I would argue, about the AI trade. That tells you about the possibilities for AI and what the opportunities could be, not just in one day, but in 1 year, in 1 decade, much, much further. Years and years from now, we will be, thinking overall and living more and more how AI is incorporated into probably almost everything that we do. But it doesn't mean that the market can't have significant drawdowns between now and then. That's the reality of long-term themes like AI. So stocks like Apple, like Alphabet, like Amazon, like Tesla, all feeling the pain today. So most of these mega cap growth names moving lower along with the broader market environment. Let's look at a daily chart of the S&P 500, see how things have sort of played out here. Let me, hold on, I have the wrong chart here. There we go. The new daily chart. Sometimes you wake up and you just need to clean house. Have you ever had that feeling? I had that feeling today. I was getting ready for the show and I was like, you know what? I'm going to wipe the S&P 500 chart clean. I'm going to start over and just identify some key levels. Because what happens with my charts, particularly something like this that I look at multiple times a day, I think of a chart like this as a running conversation, a dialogue that I have with the S&P 500 or with the markets. And I draw lines, I draw shapes, I put notes. I do all sorts of things to sort of reflect on what I'm seeing at the current moment. And what's great about it is I can save those annotations over the time. But sometimes it's like cleaning your garage. Like you just need to start over and just sort of see where things play out. So this is what I came up with. I was reflecting on the fact that the March peak around 5250, breaking above that in the last couple of weeks, I think was really meaningful. Holding that is also very important. So as we're trading down today to that open, we're basically closed just above the open on that big gap higher. This is about a week ago. And so that I think for now is a pretty key level. That's right at 52.50. Now the 50-day moving average is slightly lower, currently around 51.70. And the reason why that's an important level is if you draw a trend line from the October low, that was that major low in Q4 of last year, connect that to the April low, which is the most recent significant bottom that we've occurred. You can see that lines up with a couple additional lows in late April, early May. That currently is sitting around 51.50, we'll call it. So we sort of have this confluence of support between the 50-day moving average and a trend line using the major lows over the last 6 months. I'm kind of eyeing that as a line in the sand. As long as we hold that sort of level, this primary uptrend is still very much in play. If we break that, I think you look back to the April low, which is around 49.50, and that is Charles Dow's definition of an uptrend, right? Higher highs, which we've now done. Do we make a higher low? Which means as long as the next swing low is anywhere 49.50 or higher, this uptrend, according to Charles Dow's original methodology, is still very much in good shape. But think about the downside potential, the drawdown potential that we could experience between today and those lows. Could be a lot of noise in there. So my very simplified version of the S&P, this will probably get more and more cluttered as we go on, and I'll maybe wipe it clean again in the fall. But overall, that's what I'm seeing looking at the S&P itself. Let's look at some other breadth indicators, because the breadth picture all of a sudden with today's distribution went from looking pretty strong yesterday up into a lot less strong today. The McClellan oscillator, as of today's close, did go back below zero. It's been above the zero line for the entirety of the month of May until today. When I have a one-day break of that zero line, I look to see if there's confirmation. So according to my analysis of the McClellan oscillator, tomorrow's pretty important. It's usually usually a lighter volume day going into the holiday weekend. Usually ends up being kind of flat to slightly higher is what usually happens on a 3-day weekend Friday like this. So we'll see if it follows the normal playbook. But overall, the McClellan oscillator, if it spends another day below the zero line, I'll start color coding this bearish red, and it will look a lot like the first half of April, according to that short-term measure of market breadth. I also want to point out that with today's rotation lower, we're back below 50% of the S&P members above their 50-day moving average. And this actually could be kind of an important metric. And as I'm thinking about it, right, look at the end of last year, the S&P is at 4,800, a little below there. We had 90% of the S&P members above their 50-day. In late March, we're pushing up to above 5,200. We're around 85% of the S&P above their 50-day moving average. Now, we're breaking above there. We're pushing up toward 5,300, and we are at 65% of the S&P above their 50-day. So every time we've been making a new high here, there have been less and less stocks that have regained their 50-day moving average on that bounce higher. So it's a very interesting sort of a comparison, a divergence, I guess, for lack of a better term, of stocks going higher. The index is going higher, I guess is the way that you'd describe that, but breadth indicators really showing a negativity underneath the hood there. So keep an eye on that. Every day that we spend below the 50% range, that's not a good sign for me, certainly on the short-term breadth reading. Let's see, what else do we want to do? So many charts we could show here. I'll reflect on offense versus defense. I looked at those three growth sectors: technology, communication services, consumer discretionary. Here's the relative performance of the XLY versus the XLP. I think one of the most, I guess, one of the indications that's never really validated the current uptrend has been offense over defense. And this was inspired by a chart years ago in the Fidelity chart room. I talked with Bill Doan, who ran the group there in the 1970s, and he shared an example of a chart that they had used a long time ago. It was using old indexes which are no longer around, and tried to take what we had talked about and think about more modern ways to reflect on offense over defense. And this ratio became a pretty clear winner, the XLY versus the XLP. What's happened in recent history is, and honestly, it's been an issue for a while, is that the XLY in particular is very top heavy, right? It's dominated by three stocks that make up about 50% of the ETF. So by looking at equal weighted versions, the RSPD and the RSPS, we can look at just the clear, sort of more general rotation away between offense in the consumer discretionary and defense in consumer staples. This ratio has been sloping downwards for the last 2.5 months. We break down again, and it sort of would validate what we're seeing on the cap-weighted version, which is investors are not in the traditional offense of consumer discretionary, but in the traditional defense of consumer staples. Let's finish off looking at some individual stocks here. Of course, NVIDIA gapping higher it chopped around quite a bit, ended up finishing 9% higher, just over that, closing above 1,000. Of course, part of this earnings release was a 10-for-1 split. So coming up, I think next month in June, I forget the particular date, it'll be cut by basically 10% of the value. The shares will be cut, and as a result, it will be reflected at a much lower price. And that's done really traditionally to bring stocks back to a more affordable level. In the world of partial ownership or fractional shares, it's kind of an antiquated idea, but still psychologically, it's important enough that NVIDIA thought it was a good idea to bring their stock well below $1,000. So this might be the one time NVIDIA gets above 1,000 after we adjust lower here because of that 10-for-1 split. Now, what's interesting is the semiconductor ETF, of course, gapping higher along with the NVIDIA move today. But the SMH actually drifted lower through the course of the day. Still finished up over 1%, but instead of just breaking out and seeing a bunch of additional buyers, it actually closed down toward the lows of the day, right at 230, 240 we'll call it, which is the high end from the March peak. So keep an eye on that one. On Semiconductor is one of those charts within that group, unfortunately flashing a bearish, a bearish engulfing pattern, that is. An up day, a down day, the second day, the down day engulfs the real body of day one. So not a great look for On Semiconductor, which had recently gotten above its 50-day moving average. That bearish engulfing pattern suggests short-term weakness going into the beginning of next week. Couple other stocks, and then we will have to wrap up our market recap and bring on today's guest. Robinhood down another 2% today. What's interesting is Robinhood recently tested $21 a share. We have this bearish momentum divergence, a couple things, right? February to March, we had a bearish divergence. We have another sort of larger divergence with the move March through May and weaker price momentum. What's interesting is on the chart of Robinhood, we'll probably have to leave it here. What candle pattern am I highlighting here? This is a kind of a rare pattern, but a good one to know because it's a classic reversal pattern. It's a topping pattern. You have a big up candle, a smaller candle, which is gapped from real body to real body. Then you have another gap down, and you have a big down day. So big up day, sort of an indecision day, and a big down day. Did you know this one? It's called an evening star candle formation, an evening star. Flip it over. If it happened at a low, it'd be called a morning star candle. But when you have it in an uptrend, it's a pretty bearish sign because what happens is you have a big up day, you gap higher, which initially seems good, but this sort of small real body represents indecision. This is more of a noisy digestion day, but then the big down day basically says we're giving up all of the gains from the big up day, and in this case, a little bit more. So today's down day really follows that traditional reversal pattern. So good reminder, I'm going back to my show last week on Friday with Grayson Rose. We talked about the benefits of looking at candles, which are a short-term illustration of sentiment, on your longer-term charts and using them together in a meaningful way. So make sure you go back to our top 10 charts to watch for May. Good discussion about candle charts along the way there. That's our market recap. And again, a big distribution day today. We have a great guest, Jeff Huge, who better to help us try to make sense of things and put today's move into proper context. Before we bring on Jeff and talk to him about some of the charts he brought with us, one quick comment, and that is to send us your questions. We're going to do an all mailbag episode Friday of this week. We'd love to feature one of your questions in our next all mailbag episode. Email us at thefinalbar@stockcharts.com. On X, just tag us in a comment at FinalBarSCTV, and on YouTube, just put a comment below the video that you're watching. We'd love to hear from you. Hope to answer one of your questions in our next mailbag show. I want to welcome on today's guest, Jeff Huge. Jeff is the Chief Investment Officer of JWH Investment Partners, coming to us from the upper Midwest in Minneapolis. Jeff, welcome back to the show. How are you these days?
I'm terrific, Dave. Thanks so much for having me on.
No, it's a pleasure, as always. A big distribution day. It's certainly with NVIDIA gapping higher, but kind of everything else rolling over. So very interested to hear your take about how you put a day like this into proper perspective. You're kicking us off looking at some year-to-date returns with some interesting results I'm seeing. Talk us through what this tells you.
Yeah, it's interesting, Dave. This is the year-to-date scorecard through yesterday's close. It doesn't include today's price action, but even with the S&P down as much as it is today and gold down a couple percent as well, gold is still leading all other major asset classes year-to-date, up some 13.5%, 14% or so through today, probably. Even growth stocks have fallen behind the S&P 500, which has really been dominated by mega caps. And of course, you can look at the value line arithmetic index to figure out what the the mean return for stocks are, and that's not too impressive at something like 4 or 5%. And you can go to the value line geometric index to look at the median, and that's even more terrifying. It's not even outperforming T-bills. And of course, bonds have been negative all year, and anything that's under mid caps have really lagged. So, it's been a concentrated market within equities and including foreign stocks. But gold has led everything, and gold is a safe haven asset. And I think we need to ask ourselves the question, why is gold leading?
It's so interesting. I feel like this gap between the value line geometric, the value line arithmetic, and some of these other indexes tell you that your experience may be very different than what the S&P has laid out, depending on what stocks you're in. But gold has dominated all of them, and I mean honestly, it's amazing how the indexes are making new all-time highs, but gold even stronger. Talk to us a little bit about Dow theory. This is a really interesting one. You were telling me before we started just how this sort of triple non-confirmation adds additional weight to it. Talk us through the take here.
Yeah, recall back in 2021, we saw the late 2021, we saw the peak in the Dow on a closing basis and the transports. But since that time, the Dow has broken out, but the transports have not broken out. And so you've got a multi-year non-confirmation there. But then we can go to the point in, I think it was maybe mid-year last year, where both kind of rallied back up to those highs again. And then in March of this year, we saw the Dow make a new high, right? But the transports were nowhere near that, okay? The transports, again, put in a second non-confirmation. And then most recently, we saw on Monday, the Dow made its high, all-time high. And of course, the transports did not confirm. And so we have a third kind of a weekly scale, if you will, non-confirmation. This triple non-confirmation, I think, really the longer these non-confirmations remain in place, the more significant this potential bearish positioning is. And it speaks to the potential magnitude of a trend reversal to the downside. And what we're looking at right now is something that could be quite significant.
It feels more and more like the S&P, the Dow, the Nasdaq are making new highs, less and less things actually making new highs along with them. With that in mind, talk to me a little bit about the sentiment indicators that you follow. What are they telling you about the environment here?
Yeah, we follow a lot of different sentiment indicators, but these are two on Stockcharts that are readily available, and we like to just juxtaposition those relative to the S&P 500. And you can see in the top frame, we're looking at the National Association of Active Investment Managers. This is a good proxy for professional investors and asset allocators. And we are right back up in the 97th, 98th percentile of exposure to equities by these institutional managers. And that's slightly below the March peak of 104%, which was actually leveraged. But we think that despite the fact that the price of the S&P has made a new high, the fact that sentiment has not leaves a negative divergence in place. The same relationship can be found in the American Association of Individual Investors study, which is at the bottom frame there. And that looks at the spread between bulls and bears, so bulls minus bears. And while that got up to a point where it was 32% back in December and then rallied back up to around 30% in March, it again is back up into the high 20 percentile area, slight discount to what we saw in March, but again, leaving that kind of negative divergence in place. This often happens when the wisest cohort of investors starts to realize that something's amiss, that point of recognition. And it should be something that should not be lost on investors at this point.
As we've seen all the distribution through the course of the day today, NVIDIA obviously a positive outlier, pretty killer earnings report, gapping higher today, finishing up over 9% today. Talk to us about the weekly chart of NVIDIA. How does this sort of follow through on the trend we've observed so far?
Yeah, so we're looking at NVIDIA going back about 2 years, and if we count it off of the October 2022 low, we can count 5 waves to the upside at least intermediate degree. And within those, that 1, 2, 3, 4, 5 pattern, we've also marked the subdivisions getting into that, which puts us kind of into a fifth of a fifth wave advance right now. and we don't know exactly how long this could carry. If you used a measured move calculation, you could come up with an $1,150 target.
Mm.
But what we do know is that we're in the terminal phase of this advance based on the Elliott wave principle. What also informs our view is the fairly significant negative divergence in momentum relative to its 10-week exponential moving average, and also the lack of commitment in terms of volume. This week's volume left a lot to be desired considering the price action that we saw in the stock itself.
So we're seeing lighter volume, I think, over time here with NVIDIA. With the broader markets, April into May now have seen a lot lighter volume as well. How important is lighter volume when you think about the overall conditions here in May of 24?
Yeah, to me, it seems like there's been a lot of speculation in derivatives markets as opposed to a desire to own the underlying stock itself. And I think that's
Right.
one of the explanations that can be attributed to this.
That's an interesting point, and that's one of the toughest things, I think, getting your head around volume. There's so many things that can impact it for sure, but point well taken on the chart of NVIDIA. Let's get to the S&P. Obviously, I think a lot of people are feeling a lot of reason to be optimistic, maybe up until today when you realize that markets can kind of roll back down. Talk to us about the larger structure you see at work with the S&P, and what should we be expecting here going forward?
Yeah, so our subscribers are well aware that we've been, meticulously counting out this advance using the Elliott wave principle, and we haven't been 100% correct. I mean, it's a work in progress. Every day provides some new information, and we adapt the count. But what we've been thinking about is, really since the late April lows, is that we're in this final move up, this final fifth of a fifth of a fifth of a fifth move, and we're counting it at minute degree, and we believe today's high probably marked minute wave 5 of minor wave 5 of primary wave 5, and if that's correct, then cycle wave 5, right? And so we've got a key reversal day today, big outside down day. That typically occurs at major trend reversal points. We've broken back through an ascending trend line and around the 10-week or 10-day moving average as well. It remains to be seen whether we're going to close back below those March highs of, I believe, 52.65 or so. But if we did, sustainably, then I would think the next move down will be the 50-day moving average. And if we break through that, there's not going to be much support until we get to the April lows. And then after that, it's the 200-day moving average. And, the further we work our way down, the more likely it is that we've completed that cycle wave advance, and we'll be beginning a cycle degree corrective waveform, which will begin with intermediate wave 1 down, probably terminating around the 200-day moving average. Again, we watch the momentum model at the bottom, and we see that momentum peaked all the way back in November 13th. And so this lack of ability, despite new highs in price, to make new highs in momentum is a bearish signal. And that negative divergence continues to inform our view that the market is at or near the end of its line, I think.
It's interesting that this sort of pattern is evolving right when we enter what's known as the seasonally weakest half of the year, sort of May through October. Does that play into your thinking at all here, Jeff, or is it independent of sort of that normal seasonal pattern?
Well, I don't spend a ton of time looking at seasonality, but I did put a post out on Twitter today that said "sell in May and go away" with a question mark. And, we put a similar chart up with the VIX and juxtaposed that with the VVIX as well to show that you got a bit of a positive divergence in VVIX as VIX was making its recent all-time low or cycle low at just below 12%. And, it doesn't surprise me that we've seen a big move to the upside in VIX while the S&P is coming down following that big positive divergence in VVIX.
We only have about 30 seconds left, Jeff, but I'd love to hit this last chart looking at gold. And to your credit, you were on our market outlook, so I think end of last year, talked about gold as an opportunity, and surprising, I think, to many how well it's done going back to your first chart. Gold miners, particularly the GDXJ, an interesting opportunity here, you think?
I do. What I see here is a classic pattern base formation of the cup and handle variety. This is a monthly chart, so we're breaking out from that descending trend line off those prior highs, and connecting back here through I believe the 2020 and 2021 highs. This breakout's pretty significant. I think if it can follow through above 50, that would give us the ability to count a measured move up to around $100 to $106 range. We'd caveat that with a stop loss at 39. If we got a monthly close back below there, we'd probably move to the sidelines. But gold remains our top actionable trade for 2024. We think there's considerable upside to the price of gold. Our target's $2,800 by year end, and if we're correct about that, gold miners should follow in kind.
As always, Jeff, not disappointing, bringing a series of different thought-provoking charts, a number of different time frames represented. Can't thank you enough for coming back on the show, and we'll look forward to the next conversation, all right?
Always a pleasure.
That's Jeff Huge. Jeff is the Chief Investment Officer at JWH Investment Partners, coming to us from Minneapolis. Again, what I love about Jeff's work is it makes me think, and thinking about some of these larger structures, thinking about the weekly, the monthly time frames, and how they relate to the short term, what I call the flickering ticks. It's so easy to get drawn into one day, one move, one trend, and thinking about the larger rotations and taking a step back and recognizing how dominant something like gold has been, I think is a really powerful way to use the Stockcharts platform. Can't thank Jeff Huge enough for sharing some of those ideas with us. That's it for our show, folks. Thanks again for joining us every weekday after the close for the final bar. A special thank you again to Jeff Huge of JWH Investment Partners joining us today. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.